Well, jumping Jerome Powell is between a rock and a hard place. Friday's unemployment report came out and showed that numbers of people employed was up well over 200,000, much higher than expected, and wage growth remained robust, over 3% per year, and with inflation much below that, that means that there is real wage growth, which is good for people. Now, the problem is that the market was thinking that, well, after the previous jobs report, which showed only about 74,000 job gain, that the economy was starting to weaken enough that Jumpin' Jerome and the other Fed governors would actually cut interest rates 0.5%. Prior to that, they were thinking 0.25%. Then all of a sudden it was like, well, for sure 0.25% and a good chance of 0.5%. Now with this unemployment report, it's pretty certain that he will not drop interest rates by 0.5%. And in fact, some people are even saying maybe they won't cut it at all. So as we shifted from definitely 0.25 to maybe 0.5 to pretty much 0.25, maybe nothing, that's a negative for the market, and we're going to see it weigh on the market. We're going to see it cap any market advances. Hey everybody, Courtney Smith here with your weekly Wall Street winners. Let's get right down to it. And of course, Jumpin' Jerome Powell reads this every night before he goes to bed. All right. S&P breaks to new highs, as we told you last week, and is staying above the old highs. In other words, we didn't just poke our head up and come right back down. No, we stayed up there. So this is bullish price action. Now, recognize that we've moved hardly at all since the beginning of May. At the beginning of May, we made new all-time highs, and it's taken us almost 2 months. It took us 6 weeks to break above that, and now here we are 2 months later. This is not an explosive bull market. Dow Jones, interesting picture here, also breaking to new all-time highs. Look in the upper right-hand corner, and you see the little green line shows that buying pressure is very, very high, whereas the red line shows that selling pressure is very, very low. Now, if you go back over the chart, you'll see that we're at a pretty wide distance between the buying and the selling, and we don't usually stay this wide. We can get wider. That's not to say we can't, but it doesn't usually do it. The other thing that I would point out is that the buying pressure is basically the highs on the chart. In other words, when we see buying pressure this high, it's not sustainable. So look for the buying pressure to actually start to back off a little bit. Maybe selling pressure won't go up, but buying pressure is going to back off a bit. And that's going to keep this bull market sluggish. NASDAQ still hasn't made new all-time highs. All right, seasonality still on a neutral signal here, but it looks like we're going to at least get back up to that yellow line. Now, if we break above that yellow line, I'm going to switch it back to bullish. Purple predictor quite bullish, so it looks like we're going to at least get up to that level of about 159.50, 160, something in that area. Let's call it 160. That's what I need to turn my indicator bullish. Now, the problem is, here's another problem for the market. We're now at what should be the seasonal highs for a pre-election year. Look at the NASDAQ. That's the blue line up at the top, and you can see a very distinct high here in the middle of July. So in the next week, we should expect to see a seasonal high, and then about a 4% decline in the NASDAQ into August. Now, in the S&P and the Dow, we should sell off maybe 1 or 2%. So nonetheless, from now until beginning of August, first week in August, we should expect to see the market sell off. Now, this fits with my thesis that the market is really just simply sluggishly moving higher. Now, notice in August, then we rally back up to a September high, then we dip into an October low, and then we get our normal fourth quarter rally. So look for very choppy, sloppy price action. It might have a slight upward bias. Now, over the long run, though, the situation is really dire. I can't say it in any other way. We basically now have a negative yield curve out to 20 years, just under 20 years. You can see we've now been below zero since middle of May. We first got below in March. We rallied back up above zero. Now we've been below zero effectively since the middle of May. If we go a full 3 months, there's never been an example where we did not have a recession. Right now, I'd estimate that to be between 10 and 14 months. We'll, of course, keep you posted on this because this bear market's going to be the biggest, easiest way to make money in the next year. Asset allocation. The market is getting a little bit of money out of the bond market. The market is also looking to take a little bit more risk than they have. Both of those are a little bit bullish. Global shares broke to new all-time highs, cracked a little bit on Friday, but still they're looking a little bit better than the U.S. market, in my opinion, mainly because Mario Draghi, the head of the European Central Bank, basically came in and said, I'm thinking of doing more monetary easing. I'm going to lower interest rates from -40 to -70, 0.7%. Remember, that's negative interest rates. You have to pay the government to lend them money. That's totally crazy. All right, bonds did exactly what I said they would do, broke out to new highs, and then on Friday completely reversed that. That's very unusual price action. So the breakout came, as I predicted, but on Friday it cracked back down right into the consolidation zone that we had been in for now 3 weeks. Look for the consolidation to continue. Now, bond key factors. Interest rates in Germany, the blue line plunged to new lows. The green line, which is 10-year treasuries, are not anywhere near new lows. If you look, you can see they were lower back in 2016, but this is as low as they've ever been in Germany. Now, the CRB index, which is the black and white chart itself, it popped up in the last week. But generally, over the last several months, it's been lower, which is supportive of lower interest rates. Only gold is completely bucking the trend there, and gold is skyrocketing. Now, the dollar, if gold is going up, then normally you would see the dollar going down. We'll get to that in a second. But the dollar's shown good strength over the last couple of weeks. Here, it's gone up against all major currencies. Gold consolidating here. We got out, it looks like, at a perfect time when we exited our gold positions. I don't have a gold position right now. I'm actually getting more and more bullish on gold as we go on. But we may actually have to go down to about the 1360 area first, gain some strength there, and then start to rally. So I'm not going to get long gold right now. Now our gold key indicators are actually starting to weaken. Look up at the top. Clearly a mini bear. In the middle, kind of, let's call it a mixed bag. But the most important one, which is the yen, the green line at the bottom, it's slipping lower. So look for some more continued pressure in gold, but I think that'll be a consolidation, that'll be a retracement before we get another massive leg up. Crude oil, I'm getting more and more bullish here. I just think that we're seeing good discipline on the part of the Saudis and the Russians to keep production low. The Americans are not increasing production enough to make up for it. The real concern here for the bull case is demand. Now, demand is still growing, but it continues to grow at a weaker rate every week. Now, Bitcoin, we still remain long Bitcoin. Purple Predictor is slightly bullish. We got long down at 4,400, so we've almost made 300% on our money here over the last few months in Bitcoin. Now, notice we're consolidating. That's actually pretty bullish. After the big explosion that we had several weeks ago, the market it had a big retracement, true, from 13,844 down to about 10,000. So that's a 30% correction, but that's as far as it's got. I think this is winding up for another rally back up to the old highs of 13,844. All right, we do have a new event here. Just want to let you know, in Los Angeles, we've confirmed this. It was tentative. Now we're confirming it. Saturday, August 24th to 25th in Los Angeles. Orlando, it is filling up quickly. We still got lots of seats in Las Vegas, and the master class We got a lot of people coming to that too. Over on the option side, Orlando really is filling up quickly. We still have good seats in Las Vegas, and our master class for options coming up in October. 3 days now, 3 days. All right, and of course, I'm really worried about the future, so please do not go another minute without ordering our bear market course, How to Make Money in Bear Markets. All right, that's it. Freebies, thanks very much. All you fully paid up members, hang on there. We'll get to you in just a second.